Welcome to The Explainer. Today, we're taking a close look at something millions of homeowners have, but maybe don't fully understand that mortgage insurance the bank offers you. It seems like such a simple way to protect your home, right? But is it the best way? We're going to dig into the real cost, who's actually in control, and some of the hidden risks that you might not even know exist. Let's get into it.
You know the scene. You're finally closing on your dream home. You're surrounded by this mountain of paperwork, you're excited, you're a little overwhelmed, and then the bank representative slides just one more form in front of you. Just sign here, they say, to protect your home. In that moment, it feels like an easy yes, a total no-brainer.
And yeah, it is convenient, no one's denying that, but financial regulators and industry reports have started to raise some pretty serious red flags about what's hiding behind that simple signature. So let's peel back the curtain a bit. First things first, let's talk about the money. What does that one signature convenience actually cost you? Because it definitely comes with a price tag, and well, it's often a surprisingly high one.
I mean, just look at that number, 300%. We're not talking about a small markup here. This isn't just a few extra bucks for convenience. This is a product that can be multiples more expensive than the alternative. And that's not just a random number. A 2024 report from PolicyMe actually analyzed thousands of quotes. And, well, the results were pretty stark. They found you could be paying a massive premium for the bank's product compared to just getting your own policy on the open market. And here's the real kicker. With bank insurance, you're paying down your mortgage every single month, right? So the amount of coverage you need is actually going down. But your premium, the amount you pay every month, that stays exactly the same. You end up paying the same price for a benefit that's literally shrinking over time. So you're paying way more for a benefit that gets smaller every year. But believe it or not, the price isn't the only thing to worry about. The second major issue is all about a fundamental lack of control. I mean, whose policy is it really?
This is so important. Who actually gets the money if a claim is made? With the bank's insurance, the beneficiary is always the bank, period. With an individual policy that you own, you get to choose. You name your spouse, your kids, your estate, whoever you want. The power is in your hands. Just think about what that really means for a second. If the worst happens, the bank's insurance pays off the mortgage. It pays the bank directly. Your family doesn't see a dime of that money. They have zero flexibility to use it for other, maybe more urgent things, like funeral costs or just day-to-day living expenses. Okay, so what happens in a few years when you want to switch lenders for a better mortgage rate? Well, if you have bank mortgage insurance, you lose it. It's not portable, it's tied to that specific mortgage. You have to start all over and reapply, and guess what? You're older now, so it's almost certainly going to cost you more, assuming you even still qualify. Now we get to what our source material calls the single biggest risk of all with these products. It's a little-known practice that can turn that peace of mind you thought you had into an absolute nightmare for your family, right when they need that protection the most. The practice is called post-claim underwriting. With a lot of these bank policies, the really deep dive into your medical history, it doesn't happen when you apply. It happens after your family files a claim. This is completely backward from how traditional insurance works. So here's how it plays out. You apply, you answer a few simple health questions, you start paying your premiums every month thinking, great, I'm covered. Then, maybe years later, a claim is made. It's only then, at the worst possible moment, that the insurance company starts digging through years of medical records, looking for any tiny detail you might have forgotten on that initial form that could let them deny the claim. And look, don't just take our word for it. This is a direct warning from a federal regulator. The Financial Consumer Agency of Canada flat out tells people that because of this process, if you didn't disclose something years ago, even if it was an honest mistake, your family's claim could be thrown out. All right, so with all that on the table, how do these two options really stack up against each other? Let's put everything side by side, and it makes the choice pretty clear. When you just boil it down to the big three, cost, control, and security, it's not even close. Bank insurance is way more expensive, it gives all the control to the lender, not your family, and it comes with that huge risk of being denied after you're gone.
And a few final things to keep in mind. The person at the bank selling you this, they're not a licensed insurance advisor. Their job is to sell bank products. The policy itself is totally inflexible. It's a one-size-fits-all deal, and it forces you to jump through hoops every time you want to renew or switch your mortgage. So, in the end, it really all boils down to this one question. Your home is probably the biggest asset you'll ever own.
Given the higher cost, the total lack of control, and all these hidden risks, who do you really trust to protect it? The evidence from our sources really makes a strong case for looking beyond that convenient offer at the signing table.